Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Some news came out on Wednesday that may be a little bit surprising to those of you who follow the streaming industry, and that's that HBO is in talks with Netflix to license some of its shows to the streaming company. HBO is part of Warner Brothers Discovery and is really the crown jewel of that company. So you would think that they would want to keep it on the new Max streaming service, but that may not be the case. And this may actually be an initial move to start monetizing the content assets in a number of different ways. So that's what I want to dig into today is exactly what's going on with streaming and how to think about these companies in the future. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing, in the link in the show notes below. And before we get to this deal in particular, I want to cover what's going on in streaming today. There's over a dozen streaming services right now, and all of these companies are both trying to make their own content and tried to build out a streaming service. Now, realistically, not all of these companies are going to be able to do that. They're not going to be able to build the kind of scale that they need to actually do this economically. Peacock is a perfect example of that. I've done some videos on Peacock in the past showing just how much money they're losing and what an uphill battle they have against companies like Disney, Netflix, and even Warner Brothers Discovery. So I think investors need to think about this business in two segments. There's the streaming distribution segment. That's really what Netflix does best. This is the company that interacts with consumers. It's the service that you're actually subscribing to. It's also becoming the service that's going to be delivering ads to you. So sometimes they create their own content. Sometimes they license content from other companies, but that's really the distribution arm. Basically, they're just replacing cable from a distribution perspective. Then there's the content creation side. This is the companies that make TV shows, movies, and all the miniseries content that is ending up on places like Netflix and Disney. The content creation side doesn't necessarily have to be aligned with a streaming distribution service. So I want to break those two things apart because I think that's something that's been a little bit confusing with everything that's happened so far. Netflix started as this distributor of content and then began its own content creation studios, acquired some other studios. Disney, on the other hand, had all kinds of these content creation studios and then created a streaming subscription. But those two models, those vertically integrated models, aren't necessarily the place that we're going to end up in the future. I think in the future, we're going to have 2, 3, maybe 4 large streaming services that have hundreds of millions of subscribers, have the infrastructure to serve up ads, and then they're going to license content from all kinds of other content creators. That's exactly what we're seeing with this potential discussions between Netflix and HBO. Here's the headline from Deadline, and this was a shocker apparently that Warner Brothers Discovery is in talks to license HBO original series to Netflix. This is being dubbed as another thing that David Zaslav, the CEO of Warner Brothers Discovery, is doing that's kind of out of line with what you would expect in Hollywood. But that's not necessarily a bad thing for an executive to be doing that because this is actually probably the right move for Warner Brothers Discovery. The streaming service has been kind of all over the map the last few years. Now they've settled on having this Max app, which is going to be the main subscription service that you can subscribe to, includes HBO content. But that HBO content also sits alongside all kinds of other Warner Brothers Discovery content. So it's not the premium service that we used to think of HBO as. Those days are gone because the economics simply don't work to have a streaming subscription that's in 10 or 20 million homes and is charging $12 to $15 a month. That's just not a compelling service for subscribers, and it's not a compelling service for the companies that are creating the content. So Max wants to have this streaming service that it can put its content on, but it may also want to sell some of that content to another company that will pay it money like Netflix. Netflix has had its own problems creating its own tentpole content, the kind of content that you would want to subscribe to Netflix for specifically, outside of a few shows that kind of come and go here and there, Squid Game, Stranger Things. There's not a lot of shows that you would necessarily specifically go to Netflix for. But maybe that will change with something like HBO. So could HBO be the kind of content that pulls in subscribers to Netflix? In return, Netflix will likely pay HBO tens, if not hundreds of millions of dollars for this original content that they're selling. This is likely the model that we'll have in the future as the streaming distribution side settles out and we likely lose subscription services like Peacock and others, then they start selling their content to the Disneys, the Netflixes of the world. What I think is interesting here with this one specifically is that Max probably had a better chance of making it on its own as a streaming subscription than some of its smaller competitors. So if Warner Brothers Discovery is starting to sell its content to these other streaming companies, is that a canary in the coal mine for some of these other content creators who are now going to start selling their content to the streaming bundles? I think that's probably the way that things are going to go. But a lot of these companies have burnt hundreds of millions of dollars and they're going to be really reticent to let go of that streaming subscription and that direct tie to customers. A couple of the companies that have already done this that I think investors should take note of is Sony and also Fox. These are companies that don't have their own streaming subscription. They're more than happy to sell their content to streaming platforms and just take the money without the headache and the hassle of building a streaming subscription. That's probably going to be a successful model. Not every company needs to own its own streaming business. They can just be content creation machines and make money that way. That's the way to think about this potential deal. I think it probably makes a lot more sense than a lot of people think. And to me, it's not even all that surprising. But what did you think? Let me know in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.